All right, good morning and welcome to today's webinar. So today's webinar is going to be the top stocks of 2013, the peak performers of last year. My name is Scott Latonin and I'm one of the product coaches here with MarketSmith. And joining me shortly is Mike Webster, one of Bill's portfolio managers, and he works for O'Neill Data Systems. He's one of the creators of the Top Stocks books. We're very excited to have him here with us today. But before we get started, just want to go through a few disclosures first. With respect to the book, the data and facts, presented here have been obtained or derived from original or, recognized statistical and or trade sources. And so just keep in mind that, we're doing the best we can as far as data accuracy goes, but don't take any recommendations, don't take any of these as recommendations to buy or sell any securities or anything like that, strictly educational purposes only. And so with that out of the way, let's just go ahead and get started right now. So I'm going to bring Mike on now. And so, Mike, tell us, what are your thoughts on the MarketSmith Top Stocks book, and what's the development process behind the book itself?
Well, it's nice to be here again. The years really kind of go by fast because it seems like we were just doing this. This book is really our version of a model book. We've always had the question over the years at seminars or from people calling in of, we hear about the model book studies, which is what Bill based the entire canceling system off of. It was just studying the biggest movers in any cycle, and that's how canceling was derived, and that's how we learn around here. And we've got model books going back to the 1880s, and we're always studying them. And we always get that question of, do you sell your model books? And we don't, but this is as close to a model book as you can get, and we've been doing it for a few years now. And so essentially what we do is at the end of the year, the two of us run some screens and pick some stocks, and we work closely with Scott O'Neill, and we're trying to pick stocks that we can learn from the same way that we would create a model book for Bill or for the PM staff. And so what this is just a record of what really worked out the best for the year, and it was realistic that you can make money from. If it's a stock that just gaps up because it was acquired by another company, there's not a whole lot you can learn from that unless you're trying to anticipate a buyout, which is not what we do around here. So we handpicked these together and just wanted to have something that both of us could learn from, as well as anyone who purchases the book. So it's a record of 2013, the best stocks, and the goal behind it is look at those stocks, see how you could have made the most amount of money in each one. You mark them up, and you did a great job marking up a handful in the front to give people an idea of what it is that you should do with this book. And it's whether you print off your own charts at the end of the year or you use this book, you should be looking at the biggest winners, trying to study those and say, if I would have bought this at the pivot, how could I have held through? What rules could I write down so the next time one of these comes along, I can really benefit from it?
Yeah, and you definitely want to tailor all the rules to, kind of your own strategy as far as investing, whether you like to take, shorter-term gains or even longer-term gains. I think the ideal goal is just to maximize the amount of money that you make. And I both love and hate doing this book at the end of the year because I get to see all of the best stocks out there, that went up, 200, 300, 400%. And then I have to, beat myself up for why I wasn't in all of them, for those 300% moves. Why wasn't my account up that much? That's why I hate doing it, is because you look back and you say, well, I should have done great, or, you should have done, X% on the year. And so it's just definitely a ton of learning to do to help you, do better for the following year. And then secondly, another reason I love it is because I know that every year, there's going to be, a ton of stocks that do go up, 80, 90% on the year. And it's really just about finding them, which is actually pretty easy. I think Mike and I would both agree that we were both looking at or even trading in the stocks that did go up a ton last year. But I think managing your positions and your money management, that's a lot more difficult.
Yeah, I would agree with that. And your point that, each year there are these stocks that have big moves. There's always going to be a top stocks book because there's always going to be large moves that you can capitalize on. So the opportunities are always there. We don't always take all of them, but you can learn, you can learn from them. And each market is slightly unique, and some stocks, sometimes you're going to have stocks that are going to be harder to trade. Sometimes it's going to be more turnarounds or IPOs or thinner stocks or more liquid stocks. But if you study these each year, create your own workbooks of the best winners, that's how you're going to improve. And if you see a stock that goes from beginning to end and goes up 300%, it's not realistic that you're going to get that full 300%. But if you can get a third of that move or half that move and write rules around it that are realistic to be able to accomplish that, you do that a few times, it's going to have a really material impact on your life.
Okay, so let's just jump. So that's the kind of the purpose behind the book and how you should kind of use it. So what we've done today is we have a few examples of different markups that we've done. Before we get into the specific examples, with respect to the stocks that are in the book, what we did is we looked at the best performers of the year and we organized them by sector. So you have the sector in the book from A to Z, and then you have the best performers within each sector for that specific sector. So you have the best performers at the beginning of each one. And so here are the criteria here. I'll kind of just briefly go through them. So, it had to go up at least 40% last year. The market, that means it just had to outperform the market. I think the NASDAQ was up like 39% last year. So it just had to exceed that percentage. We have some average daily volume requirements just to make sure that they were somewhat of a liquid name. It wasn't just 1,000 shares traded, because you really can't get a whole lot of size in that, obviously. The peak price for the year, so if it started at $5 at the beginning of the year, it had to have at least gone up to $20, during 2013, just to make sure that, if it was a lower price stock, that it did give you an opportunity at some higher prices to make some money there as well. And then lastly, with our last criteria, it had to be within 30% of a 52-week high at the beginning of the year. That's in essence, that's just saying, it couldn't have been down 50% at the beginning of the year and then come back up to, break even, so to speak. Up 100% would be break even if it was down 50%, off the high. So it had to at least make some price progress last year, just so that it's something, a stock that we would realistically be looking at and trying to invest in. And so kind of the basics out of the way, let's just jump into our first example here. I'm kind of going to lead in with the fundamentals of each company first. But here's, all of these stocks are in the top stocks book. The first one we're going to look at is LinkedIn. And so on the left-hand side, you'll see the weekly chart. In the book, it's all weekly charts snapshotted at the end of the year, December 31st, 2013. And so on the left-hand side is where all the fundamental and technicals are. And so just a few that I've highlighted here that this is what I would do when I'm using the top stocks book. And so I'm going to look back and say, okay, this stock had a huge move. What specific about it was unique? What are some key characteristics to focus on? You could do an exhaustive, research on each individual stock, but there's 125 stocks. So I thought, maybe just some key unique characteristics might be best, especially for this webinar, just to give you a feel for what to do. And so you'll notice in red I have a negative characteristics, the return on equity of only 13%. We all know that return on equity, of 18% or higher is going to be, kind of your ideal, winning model book stock. But in this case, it was only 13%. And so you might wonder, why I highlighted a negative. Well, that's because, the stock went on a great move with a return on equity that was actually pretty subpar. And so that just kind of reminds me that I know that all stocks, or I should say, there are no perfect stocks out there. There's always going to be one weakness about a company. And in this case, for LinkedIn, it was the return on equity. And so the way I kind of justified it to myself was, well, okay, I can overlook the low return on equity if, it has earnings and sales, triple digits or high double digits. And that's why I have the earnings and sales, highlighted down here in green. Because, look at the earnings and sales figures. We've talked about a lot about the earnings and sales during the fundamental webinar each month, and we're really looking for the triple-digit growth. That gives you the dynamic, innovative companies that we want to be focusing on. So that's kind of the two best features about the stock was the earnings and sales growth. And then secondly, the worst thing about it, and for me anyway, was the return on equity. But the strengths definitely overruled that one weakness.
Yeah, and I like that you did that, and it's a really important point to get before we talk about the chart and the move that it had, is to understand, as you said, there's no perfect stocks. In fact, a lot of the big winners, have a few flaws in them. You don't want to have too many flaws. And we both went through and we handpicked what's in here, and some people might be surprised that there's certainly some stocks in here without earnings, and that happens. There are stocks that move up on a story or on sales growth or some other metric, and we wanted to include those. The reality is, if it had a big move and is something that you could realistically make a fair amount of money on, we wanted to include it in here. And so when people are relatively new to CanSlim, what I've found is people will read Bill's book, they'll look at all the different criteria, what the current earnings, annual earnings, return on equity, and so forth are, and expect a stock to have every last one of those. And we would love that, but the reality is that there's a balance in there, and the only way to understand the true balance is to study reality, study what was really out there before a stock had a big move. And so I think it's great that Scott is highlighting some of the negative stuff on here. Why don't we get into the chart? Okay, so when you're sitting down with this book, or any charts that you've printed off and you want to study, go back to the original base where the stock started its move and really study that one carefully. You can do an exhaustive week-by-week analysis. Anyone who's seen Bill do that or seen me do that at one of the seminars, it's a very good way of learning how to interpret a base where you're looking at the price and volume action of each week within the base and letting it try to tell you a story. Is the stock under accumulation more than it's under distribution throughout the space? And you want to look at some key things. Look at the little blue area we have there, the tightness in the handle. That's something that is very typical within a stock before it launches into a large move. And look at the number of weeks in a row up on the right side. You've during the move you have 13 out of 14 weeks up, but before that stock even breaks out, you've got several weeks in a row where the stock is just being bought steadily, but it's not dramatic. And that's something that we've recognized in leading stocks before they make their move. And our interpretation is they're big funds, they're establishing a position, and it's going to take them a month or so to do that. What would you like to add on this?
Yeah, the only other kind of criteria I'd like to add is that, coming out of the second stage base there, around 200, it's very easy to fall into the trap of, okay, from the prior base, it went up from 120 to, 200. That's about 75% move. And you would have been kicking yourself if you had sold it at 20% higher. You would have missed out on a lot of potential there. However, so I think a trap to fall into is, okay, well, it's coming out of the second stage base at 200. If it goes up another 75% or even 50%, that puts it at 300 to 350. And so I think the tendency is to kind of, now that you're later in the move, is actually to hold on for a bigger move. Whereas in the beginning is probably where you're more likely to actually, have a bigger move from earlier prices. And so at this coming out of the second stage base, it's probably better just to take your 20%. Even if you love the fundamental story and you have a lot of conviction in the name, it never hurts just to take a little bit off the table at 20% up, because you don't know if it does what LinkedIn does and really fades pretty hard after it hits 20%, or if it keeps going upwards. You never know what's going to be, what's going to go up 100% and what's not. So I think a good rule of thumb, at least for me anyway, is just take a little bit off the table and then see how it acts. You can always buy it back later, if it forms another base or pulls back into the 10-week line or whatever the case might be. But I think just being a little bit more, being proactive about, taking profits is never a bad thing.
I think that's a great point. And it doesn't have to be an all or none situation, as you're saying. You can sell some of it because, the stock could have easily just kept moving higher from there, and I thought it was personally, and I was trading it accordingly, and so you learn something. And so I think it's great that you're pointing that out, and it's one of the things that Bill has been talking to the PM staff quite a bit about is locking in profits along the way. Something else that I would say, whether you're looking at this chart or any others within this book, is what is your goal, and what do you think is realistic for you to be able to do? And it'd be great to say you're going to buy it, perfectly right at 105, 110, and then sell it top tick. But that's how are you going to recreate that? So maybe you just want to get the bulk of the first part of the move out, and you could study it and say I want to hold this stock, any stock that breaks out for X number of weeks, 8 weeks, 13 weeks. Just give it as much room as possible. You could have a rule that says, I'm just going to hold it until I have a decisive break below the 50-day or the 10-week line here. Have some sort of rule, and as you're going through, this book, see how that would have worked out for you. And, you could have bought it at the original breakout and said, I'm going to sit through it for, until the stock breaks it in a really bad way, the 10-week line, which it does there around the, the 220 mark. And so you would have, had a huge advance, implementing that rule. It might have shaken you out around the 170 area as well.
Yeah, and then, if you do get shaken out, though, just kind of always be ready for, a new base that could form. And so, like LinkedIn, even if you did get shaken out around 170, I think like a lot of people did, had a big earnings gap down and then continued lower when the market looked pretty terrible at that point, too. But, it reversed itself and came back, and so you really need to be able to buy it back. That used to be a big flaw of mine, until I started doing these post analysis was, well, I could, if I sold a stock, for example, at 170, it'd be difficult for me to buy it back at 210 because, that's 40 points higher than where I sold it. However, you really shouldn't be thinking about, that type of thing. You should be thinking about, okay, you really need to be in the stock when you should be in it and out when you should be out. And so as long as you think that, there's still, potential to the upside, then you could probably still, you should be able to buy it back, with some confidence. We have a good follow-up question regarding you were looking at the base on LinkedIn. Do you look at the weekly closes in the base as the majority of the weeks closed above 30 or okay? So he's basically looking at support weeks within the base.
Yeah, the closing range for me and having I've had the privilege of working with Bill closely for well over a decade, almost a decade and a half, and I tend to get from him what's important and try to do the same thing. And when he's looking at a base, the way he teaches us here is you do a week by week analysis, and one of the key things is where that stock closes within the range. So the close to me is very important. That's something I've learned from looking at thousands, hundreds of thousands of charts, but it's what I've learned from what Bill has taught us. And so looking at this base, there's a couple things in here that I think look terrible, but so for one, that the week right before the bottom week where it's stuck underneath the 10-week line closes, it's a blue week, closes in the lower part of the range. That looks terrible, and then the next week closing at the low. I mean, that is a horrible portion of that base, and that's why it's important to look at it. Is there something that's compensating for it on the other side? And that's the right side of the base is very nice, several weeks up in a row. Most of those closing at the highs, that's critical. And the tight areas and the shakeout in the handle, and the fact that as you move forward in time, that the 10-week becomes support as well as your black line there, the 40 weeks. So. And sometimes it's a story that's moving, and it's the fundamentals that are driving it. And if those earnings didn't come out good, the stock would have fallen apart, and it wouldn't be in this book.
Yeah, and I think that's a good point you made. I just want to say the same thing almost, is just reiterate kind of the emphasis for me is that, Bill's always saying, it's the earnings that makes a stock go higher. It's not the chart pattern necessarily. And so, we do have obviously things to look for as far as is it a good base or a bad base, et cetera. I think that would just adjust probabilities, in your favor or out of favor. But I think, at least for me anyway, it's really the fundamental story that drives the stock price. Whether it's future earnings or sales, or the current triple-digit earnings and sales like LinkedIn was. I think it just really comes down to a matter of what's important really, and it comes down to what's the fundamental story. Why should it go up 200%?
Yeah, I agree.
All right, so moving on. Next stock we're going to talk about is Starbucks. This is a little bit different of a situation. The other, LinkedIn was obviously, a high growth name, the triple-digit earnings and revenues. So in this case, we're not going to see that this stock's company's obviously been around a lot longer. And so, a few different metrics that I find particularly important, especially versus LinkedIn, return on equity, at 35%. I mean, that's an extraordinarily high return on equity. And just to contrast it against the LinkedIn's 13% return on equity. And so we can really see that management is a lot more efficient as far as driving net income, especially versus the shareholder equity. And so you have a really high return on equity. And I know I think when Bill did his super stocks webinar, I think last year with Scott O'Neill, I think he mentioned he really looks at 40% return on equity or higher. That was a big metric for him, was the higher the better.
The higher the better with anything, with any of our numbers. And so you hear us, and I think that's a great point, Scott. When you hear us talk about our minimums, those are the minimums that we find that are acceptable, and he'll reiterate that all the time. And so for last quarter earnings, this one is kind of mediocre at 24%, even though there was some acceleration. That's not an ideal candidate for something that we think is going to have a massive move. But you want to take the context of what it is. This is Starbucks after, a decade plus of having an enormous run. All you have to do is, pull up Starbucks on a monthly chart and you see, this is not a new company, and it's well established, and that's great because you want to trade those too, because look at the nice move that it has. It's a lot easier to hold this one than the LinkedIn that we just looked at, and you should take something away from the stocks that we're picking in the book, as well as the stocks that Scott picked to go over today. Is these are names that everyone can understand. I mean, everyone listening has been into a Starbucks, probably within the last week. You can get it. You can grasp what that is. LinkedIn, I know a ton of people, that use it, that, helps them, be mobile within the job market. And it's stocks that we can understand, we're going to trade better. If this is a semiconductor that, neither of us here could really understand, we're probably not going to trade it very well.
Yeah, and another I guess metric I highlighted was the earning stability. This is the exact opposite, where the lower number is actually better. It's one of our I think it's our only rating science industry group ranking that is like this. And so, at 13, that's extraordinarily good. One would be best. 13's going to be very stable earnings over the last 5 years, and you can see it with the EPS growth rate of 30%. And so they're really just be a great counterbalance for the portfolio. It's not going to be your high octane stocks. It's definitely going to be one that is going to be, a slow and pokey stock that gives you, not, maybe easier, 20% gain as opposed to a hard, 50 or 60% gain. And so, and then here are some different, now we have to take a look at the cup with handle.
Yeah, so looking at this cup, it's not ideal. And that's, it's the way, we kind of talk about it in-house is kind of a scoop in the middle of the base. Just seems like it's not there. This is almost, has a double bottom type feel at the bottom, with the second bottom, being higher. That's, I would have liked it to work out the other way, but that's why we're studying these, and you want to look and see the left side of the base. It was holding in tight, and then all of a sudden it broke down. That is something that I would go into Market Smith, and I would go and do a change date and see what did the stock look like at that time. And because a chart looks completely different when you change a date because of the compression of the move all the way up to $80. And so you want to know what it looks like so you don't write a stock off, because I know at that point it would look like a great short candidate. If any, it doesn't mean you buy it down there, of course, but it's important to use a change date, go through, understand how a base looks as it's forming. And this is not a perfect looking base, but if you did a week by week analysis, you see, on balance has more positives than negatives, and of course it has a lot of tight areas in there, and it really forms that base on base, which is where you probably, most realistically be buying in and being able to hold it. Because if you bought it from that cup with handle, you're probably shaken out, or you could have been shaken out during that little tiny that flat base.
Yeah, and then just one more thing I wanted to highlight is, you have that easy, support level, the 10-week line. This, after it breaks out of the cup with handle and then the flat base, it obeys the 10-week line extremely well. It's very organized around it, never closes below it. And so, I just wanted to highlight one thing, here's your expectation breaker. It does something for so long, and then all of a sudden it reverses expectations, and now it breaks through the 10-week line. And this happened, I think, to be on earnings, perhaps. I actually don't think it was in second thought. But, you got a big increase in volume as it, closes significantly below the 10-week line. It's kind of like your overdue break below it. And so this kind of gives you a feel for, okay, well, you could lock in some gains right here, especially if you'd had it, ever since 55 or so.
Yeah, and I think a good point on this one, I love how you marked on there the break of the 10-week. What I would suggest you do on a stock like this is, go and look at the daily chart. And you probably, if you look at the daily chart, there's probably a million times where you could have been worn out of the stock, or, what I tend to do is be a little bit impatient, and if the stock isn't doing something, then I'll reallocate my capital to something that's moving. that's why it's important to look at this weekly and say, is this stock doing anything wrong? There's always going to be some faster stocks out there. But if you can get some cushion behind you in a name like this and use something like the 10-week line as your guide and just say, okay, I'm just going to wait for that break. And I was surprised when it broke like that. That was very unusual, but it was very nice because if you were in it, like you said, it's an expectation breaker. It had, all those tight areas on the way up, and it looked like it was just really under accumulation. And I don't remember what was going on there. Is that when you were quitting drinking coffee or something?
Well, I would never do that.
Yeah.
Yeah, but regardless of what the news was or anything like that, you see that action, and that's kind of like your first shot across the bow that, hey, maybe it's time to, take some profits, or if you bought late, maybe it's time to cut losses if you got it around the 3 weeks tight, or it's like 7 weeks tight, it looks like.
Yeah, I would definitely exit the trade at that point. And you made the point, you can always buy the stock back, and it never bothers me to buy a stock back higher.
All right, the next one we're going to talk about maybe a little bit unconventional, which is actually why I wanted to bring it up in the first place. And so, it could be a big potential leader going forward. Obviously, after the most recent earnings announcement, not reflected on the chart because it was this year, not last year. It's going to take a little bit longer to form maybe a new base or, whatever happens here. But it's Twitter. And so I just want to take a look at a few different things on here because we get a lot of questions, especially when we talk about and people are looking at the Growth 250, that's our other premium list of ideas. Well, it includes, a bunch of IPOs. Well, there's always going to be IPOs in there that don't have earnings or don't have sales or their ratings are terrible. We get that a ton. And so we looked at all the different IPOs, going back maybe 20 or 30 years when we first did this webinar. When we first created the Growth 250. And what we looked at was, okay, as long as the IPO has something good about it, we want to, kind of highlight it. And so the first thing I wanted to mention was, well, here's the negative earnings or negative earnings growth. It's losing money every year. However, if we look at the revenue growth, we have actually 8 quarters of triple-digit earnings growth, of sales growth, and that's pretty good. I'm pretty sure most companies would want their products to be or that have that kind of revenue growth going back a couple of years. And so as long as there's something good about it, we want to track it. Also, it happens that this is a big institutional favorite. Everyone knows about it. It's already a $35 billion market cap company, which excessive or not, that is what it is. And so another key factor that I like to look at is where the stock trades on the first day versus its IPO price. And I think Bill highlighted it with the stock in How to Make Money in Stocks, but the IPO price on this was 26. It actually started trading, I think, in the mid 40s. So that's just telling you that there was a ton of demand for the stock, especially initially that it opened significantly higher than where the IPO price initially priced it.
Yeah, and I agree with everything you said, and I think this is really valuable to study something like this. And we all know that as you mentioned, it gapped down on earnings, and earnings can be just a complete crapshoot. It could have gone the other way if the street interpreted the numbers differently. But it's worth studying all of these, and that's a classic looking IPO base. It's a little deeper than what the pattern rec currently is picking up, but we're making some adjustments there that will be out in the near future. But this looks just like all the other IPOs that we've studied that have launched into really big moves. But more than that, because there were a lot of IPOs last year that that I passed up on. Maybe they were biotech, and I couldn't really grasp it, and the charts looked great. But Twitter is something everyone can understand. You can understand LinkedIn, Facebook, Twitter, things that you use, your friends use, and so I like trading those types of stocks because you can have something to fall back on as far as just your normal type of research. And then you still have to analyze it because there are tons of companies that I love their products, but their stocks are terrible for years. So just because you like a product, use a product, doesn't mean you buy the stock, but it certainly is going to help you be able to understand it and understand what that potential is. And something like this, there's huge potential, and that's why the stock was making a move like that. And I think it's great that you pointed out that huge demand for when it went public, and that also is saying something about the underwriters really getting it right, because there's a balance between pricing it where the company gets enough money but also where there's, they're just giving out a tiny little bit of supply. So it's always a supply-demand situation.
Yeah, and then another metric that I highlight at the bottom left is, this was one of the best industry groups, pretty much all of last year for the most part was the internet content group. And so at the bottom left, you can kind of just see that I highlighted a few different, that data block down there that shows you, okay, there were a ton of other stocks that also had, great relative strength and great earnings per share ratings down there as well. And then so, like Mike said, here's the IPO base that it formed and broke out of. And then, it did give you a good return especially in a couple of weeks, from 50 to like 75. Obviously not a huge sustained move so far. However, it was a good, trading, I guess, opportunity as opposed to an investment at this point. And so, we'll see what happens going forward.
And let's just go back to that one real quick. I see that there was a question about the Twitter, and I think I mentioned at a seminar that I didn't buy it out of there. And sometimes you make mistakes and you miss a stock, and other times you have to balance your portfolio out. And I think I had another stock, in that group at the same time. So keep in mind as you're going through this book, sometimes you're going to have to miss a stock just simply because either you don't have the capital at the time, because what the general market is telling you is that maybe you should only be certain percent invested, or you're trying to write out some other positions, or you already have too much exposure to that group. It doesn't mean you can't sit back and learn something. I think there's a lot to learn from this Twitter move, and there's also like I said, the crapshoot of an earnings announcement that, it is just, on some level, it's just a gamble that happens.
All right, so moving to another name, FleetCor, it's actually a stock that's done tremendously well over the past year, went from 40 to 120. And I think it is probably still off a lot of people's radars. Not necessarily that it's going to go higher from here or anything like that, but usually the ones that you don't expect to have big moves end up having big moves because nobody expects them to have them in the first place, as contrarian as that sounds. But this is another type of situation where this was definitely a slow and steadier stock than the Twitter or the LinkedIn that we looked at. It definitely had the opportunity to, be a little bit too slow. Maybe you didn't make money fast enough or whatever the case might have been. But it was a very organized trade. And just a few things I want to tackle. With the earnings stability rating, it was an 8. We looked at Starbucks. I think it was a 12. So this is even more stable on a 5-year earnings basis. And if we look at the quarterly earnings and sales, we can definitely see how steady they are. I mean, it's in the 20s, 30, pretty much mid double digits, over the last couple of years. Same thing with the revenue growth as well. And then just the most important thing for me on the chart itself, anyway, was just the relative strength line. I mean, you normally don't get to see relative strength lines that do go up at 45 or even 50, 60-degree angles like that. Usually there's wiggles and wobbles along the way as they build bases, but this was one of those rare instances where it pretty much just went straight up.
Yeah, this is an unbelievable move, and there's so much to learn from this one. And I look at this in a way that it's kind of in the same family as the Starbucks that you mentioned, and that the earnings stability was there, but it's at a completely different point in its growth. Starbucks has been around forever, as we mentioned, and this one is a new, recent new issue. And look at the growth there that you pointed out. Instead of coming in at a mediocre 24%, there's some acceleration in there. Coming into last September, you were going from, single digits all the way up to, 40s and 50s. And so that's what drove this stock. I mean, we like to, the reality is a stock's move is going to just follow whatever the earnings do. And your job is to, pick the stocks with the big earnings, with the big stories, the institutional quality ones, and then use your charts to help you navigate where to get in, when to know that there's something wrong with it. And the great thing about this stock is there wasn't anything wrong with it if you had the patience to sit back. So I think in this entire book, there's probably more to learn from this chart than any of the other ones, in that you should be able to have one of these in your account during the year where you just say, you know what, I'm going to give this a shot, and I'm just going to use a rule like a 10-week line, and say, I'm going to wait for that Friday to happen, no matter what's going on midweek, unless it's, the stock gets cut in half or something really crazy goes on. Wait until Friday, see if it closes back up above the 10-week line, and I'm just going to let the stock run and look at, I never would have thought that this stock with this story would have gone from 40 to 120. And Bill's been able to make a ton of money on names like this where if it doesn't test you, he has the patience to sit. And I think that's what I take away from this chart is, just sit back, stop looking at an intraday, don't look at it daily, don't look at the general market sometimes.
You don't think the 5-minute chart's important?
I used to 15 and 30, but I got away from the 5 a long time ago. That'll drive you crazy. I think that probably took like 15 years off my life.
Just like you said, you never really know, how much potential a company has. This stock always reminds me of a colleague. He was looking at it coming out of the first cup, back in 2011. He said, you know what, it does. I still don't know what they do. They do, credit cards for, I think, fleet services or something like that. I still have no clue. But regardless, he said, there's a ton of potential in here. It probably goes a lot higher. And I was like, yeah, whatever, dude. And I was looking at other, stocks that had, a ton of growth, whatever stocks they were back then. But yeah, so it just goes to show you that, you never really know what a stock has as far as potentially. And so you kind of just have to, do the best you can. And then once you're in the trade and everything's going well, you just have to manage the position accordingly. And then, like Mike said, maybe have a rule where if it closes below the 10-week line, then that's your first sell. And, sometimes it works out a lot better than anticipated.
Yeah, another thing I would take away from a stock like this is if you recognize that you're in a name like this, at least for me, with my personality and how I know that I trade, is I would personally not want to pyramid into this, because with this type of move, I know that I would be running my average cost up and I wouldn't be able to sit as long. So sometimes, there are other stocks that are perfect pyramiding stocks, that maybe they're going to be a little bit more volatile, but with a name like this, I would just buy a position and just try to do your best to sit and just let that thing grow and keep your eye off of it during the week, and then just study it over the weekend. And
actually, another interesting facet about this one was, it didn't really provide you too many, basic opportunities to buy out of. It had that first cup at 40, and then actually the next base that it formed is all the way up at 90. And so, if you missed out initially, then you're stuck kind of having to get in off the 10-week line. It does a few different tight areas, but I'm not a huge fan of buying out of a 3 weeks tight. It seems to be a little extended at that point. However, the 10-week line seems to be a great location to buy it, especially if you said, if it closes, above the 10-week line, like it does, a handful of times, you could definitely, I think, get a position there. That way you kind of know that you have an immediate, expectation rule where if it closes below the 10-week line, you can just get out really quickly. And so you really are able to manage your risk accordingly there. So I think in this instance, even on most stocks, I feel like the 10-week line is usually a great place to look for an entry if you missed it, especially in the very beginning.
Yeah, I think that's a great point. And how I would study this is I would take, a handful of names out of this book and really just say, this is the ones I really want to study out of what happened in 2013. So for me, it would be something like this, because I've studied a lot of the faster type of moves, but I need to, study these more and understand how they operate a little bit better. And so what I would do is do a change date back to, a month or so after it broke out of its original cup, print off a daily and a weekly to get your mind on what this stock looks like at the time when it's not compressed from 120 all the way down. And look at that. Look at how it bounces off of the 10-week line and write some rules and just say, okay, using a daily and a weekly, where would my entry points have been and where would my exit points have been if the stock didn't work out? And just write some rules around it, maybe create a little notebook where you've got several daily and weekly and maybe even monthly charts in there of your, a handful of these names. And we really use that change date tool. I can tell you that, all the PMs at the firm, as well as, I know, a lot of the Market Smith staff that, we're using it all of the time, and it's one of the best features we have, and I think it's probably one of the least used. Would you say?
Yeah, I'd say most people aren't really aware. And so just so that everyone's on the same page, you can go back to a historical time frame. You can't see it on this chart because it's a PDF of the top stocks book chart. However, at the top center of the Market Smith chart, you'll see a date that you can go ahead and adjust going back. You won't be able to see the historical earnings and sales or anything like that, just the price volume action. but that's really what we're studying, is trying to find a precedent, or even just trying to find some models as far as how a stock should or even shouldn't act after a breakout, or off the 10-week line, etc. Actually, I have a question here regarding could you please elaborate on why you feel FleetCor is not really a great stock for pyramiding?
Oh yeah, that's a great point. And I think, Scott, you mentioned it a little bit, is your entry points. It doesn't give you a lot of entry points. So your first entry point was your cup, and that's what we're studying. So imagine you bought it there, and it just kind of dead money for a while, and that, I think, would have worn me out, because you've got several weeks in a row that are closing up, but it's just up a tiny little bit. So imagine you bought it there, about 42 or so, and you've got several months, and you're just up a little bit on it, and there's no place in there that, using hindsight, that you would have wanted to pyramid. So let's say you wait until the stock almost breaks through 50, and that would have been a place that, with hindsight, and that's what you're doing with this. You are using hindsight and saying that, where you could have added, and that's the time element is important in there too. It's taken so long, that I just know that at that point, with the stock that's moving, that's so slow, I'm not going to want to allocate a ton of additional capital. Now, you can ask Bill, and he might look at it a completely different way, or Scott, you might look at it a completely different way. I'm looking at this and going, I know my personality. I know that sitting with the stock for months and months and months for a tiny little gain, I'm not going to be able to handle that if I've got a lot of my capital in there. So if I get a small, medium-sized position that I can just kind of tuck away, and it's not eating at my buying power, I can do it. But if I've got a lot in there, I'm more likely to blow out the whole position and move it into something faster. So sometimes it's looking at a stock and just understanding your own personality, how you trade other stocks. But you could also say, hey, yeah, you would have wanted a pyramid every time it came into your 10-week line and just had a ton of money in there. But that's not how I would have looked at this.
Okay, so let's kind of continue on. I know we're kind of not necessarily running out of time, but I do want to make sure we get through all the slides. So the next one we'll take a look at is another unconventional winner, Yahoo. Obviously a big former winner from back in the 90s. It's rare to see them come up again, especially after they've a lot of competition has come into the market, and a lot of things have really changed out there in the world. And the market's no longer the same, obviously, like it was back in the 90s. However, with Yahoo, a few different things I just wanted to point out. With the earnings, you actually have some earnings acceleration coming in before the big move here when it broke out, late, actually early last year. But the revenue growth wasn't there. And so we have a few, mixed signals so far, earnings versus sales growth. That's why we're always trying to use like a balancing act as far as positives versus negatives. A big thing for me, though, is it has a new CEO. We all know the Yen and Can Slim. We actually talk about it every month on our fundamental webinar. But one of the concepts of the Yen is a new CEO. Someone to bring in maybe from caretaker management to new management as far as dynamicism or looking forward for high growth. Whatever the case might be. But we have a new CEO here as well, and the earnings have been going up for actually the last last 4 years. And so you have actually what's going on is earnings compression, and so the price isn't going anywhere, but the earnings are going higher, and we always expect earnings to be a appreciative stock price with earnings increases, and so we're seeing this type of thing where the price hasn't been going anywhere for a long time, and the earnings are increasing, and so that gives us a little bit more conviction that hey, maybe there's some winning potential here. And then secondly, we also have some insider purchases here as well. We see insiders sell for obviously a variety of reasons, whether it's to fund college or to diversify their holdings. But insider purchases are going to be a lot more rare. Maybe it was a corporate buyback here. However, they have some confidence that maybe the fortunes of the company have changed.
Yeah, and what I learned from this is, to try to not have a bias against something. I use Yahoo all the time. I love their site. I've used their email forever. I think it's great. But I had a bias against it because, it's even back when I was trading the internet stocks, I was more, trading Google than I was Yahoo. And I looked at the numbers on here, and I didn't trade the stock the whole time, at least off of memory. I don't believe trading it, over the last couple of years. And I was wrong because the stock went from, $16, $17 up to $40. So that's what's worthwhile in studying some of these that you just missed and say, did you have too much of a bias against it? Or, given even, the move that it had, are you still comfortable with missing out on the move? And so what I think is there was something else in there, that sign of the 8 weeks in a row up is telling you things have changed. And I love the fact that you pointed out the compression, as the stock, it really isn't going anywhere, but the earnings are starting to, recover. And so that's great. Keep in mind, you don't have to trade every stock out there. And if you don't think that you're going to have the conviction to sit through, like look at that double bottom in the middle of it, I know that if I was in it with my bias against it, I would have been shaken out during that. But, with that said, you still, you want to be realistic and say, okay, do you have too much of a bias against it? Is it, something that you just would never trade, like a low price stock, like a really low price stocks under $10? I would just never trade, just wouldn't do it. And so I don't even bother studying those. But this one's kind of more in a gray area. It's hard seeing negative sales growth and getting excited about a stock for me.
Yeah, I definitely agree with you. It was a tough one to really get a lot of conviction in. However, you just kind of let the chart tell you when to be in or out it, or if you use the 10-week as a line, it held it pretty well. Or even just bought each base and sold up 20%. It looks like you did decently well in addition. And moving along, a very similar situation with Celgene. I know a lot of people were talking about that last year. Just a few things to really pick up on, and it's probably been discussed ad nauseum. So I just want to be pretty brief, just some key things. Earnings stability, it's the best we've seen yet with a 2. And so just telling you that, look, their earnings are not going to deviate from the norm in a very consistent way. They're always going to be making almost the same amount of money each time, which can be a very good thing, especially during, tough markets. And now that we've seen, the pharmaceuticals really, came up last year, especially with, Celgene, some other ideas out there, but this industry group's been on a tear. Definitely one of the leaders, especially last year, had extremely strong return on equity at 39%. And then if we just look, another similar situation where we have that long price consolidation sideways where the price isn't really having a whole lot of progress, but at the same time the earnings are increasing, year over year. We get that PE compression going on. And then another indication is that insider purchase again, especially, at key times during the move. At the bottom or near the lows of this base, you didn't really know they were lows until after the fact, but at the lows you do see some insider purchases come in. Just telling you that, hey, maybe the company has, some valuation models going on in their, internally generated ones that show, hey, this company is, undervalued, whatever the case might be, but insiders are definitely, kind of backing up their talk with, their money.
Yeah, and, biotechs, that's a great group to trade in. Keep in mind that you just don't ever want to be too heavy in any one group, and that's how heavy is really a personal thing. But if a group has a move up or down, you want to be able to withstand that. More importantly, on the way down, of course. And so with the biotechs, I know Bill's made a ton of money over the years. In Amgen and Genentech, and some other ones, and Syntex, of course. So it's retail and biotechs is where we like to trade, but I find it difficult with the stories with them. I don't know about you, Scott, but every time I read a story on any biotech, whether it's one that has no earnings or one like this that is very stable, they always sound great. I mean, if you don't look at the chart or the earnings or the estimates, all the stories, there's a couple hundred biotechs and every story sounds great. They're going to get rid of some terrible illness. So I find it personally difficult to, that aspect of it because you can get sucked into the story part. So you want to really pay attention. If the stock starts going against you, don't fall in love with that, the story. And so the earnings were there. The institutional sponsorship was there. And you just go through and you interpret the base. And the key takeaway on this one is where would you have bought it to have been able to withstand the wiggles and wobbles, and that tells you, if you buy it right, that's going to fix almost all the problems, because there's lots of wobbles in here that would have been very difficult to hold.
Yeah, and so not only do you have some institutional conviction, I guess, coming at the beginning of the move, the pattern recognition will identify with the largest volume on the weekly and daily charts. It's just telling you that institutions are really coming in and buying the stock or selling the stock in a bad way. In that case. But another example of what gives me conviction, especially in biotech, is going to be the market cap and the average daily volume. If it only trades 100,000 shares per day and it's a new issue biotech that's $500 million company, I'm going to be very wary as far as the company's concerned, because they probably haven't proven revenues or proven earnings yet. This is just something personal for me as far as what I look for. But I know that if it's a big company and it has proven earnings track record, then it's more likely to probably not disappoint in a terrible way, because we all know that FDA approval can be a tough process where the stock can be down 50% or up 400%, like we've seen with some cases recently. And so you're going to miss out on those big movers if you focus on the big cap stocks. However, I think adjusting for risk, you're probably better off, especially being able to manage your positions accordingly.
I agree.
All right, so that's the last stock. So just to kind of summarize what the top stocks book is, it's just the most notable stocks of 2013 that we all handpicked. There's 125 stock charts in here, all the weekly charts snapshotted at the end of the year. 6 of them have been marked up by the MarketSmith team here, and you'll see them in the book in the very beginning. There's a picture at the bottom. But yeah, so really what it's designed for is for you to go through and analyze the stocks, write rules for yourself that will help you handle the biggest winners and make more money in the process. And so lastly, just to put it all into practice, the book is $89. We also have some issues from 2011 and 2012 books. Definitely, call us and inquire about those if you're interested. But just so the reason we marked up a few charts in the beginning and the webinar was to give you a feel for how to do it yourself. So study the marked up charts, see if you can apply them towards your own, research routine. Hopefully you can, improve on something. Maybe, there's a rule that really helps you make a ton of money. We really hope so. That means you'll be a long-term client of ours. Definitely take a look at How to Make Money in Stocks by Bill O'Neill. A lot of the first 100 pages in this book are, some of the model book stocks, that go back a number of years. And then lastly, definitely use the book. A lot of people buy it, it sits on the shelf, collects dust. Definitely just mark them up and go through them just to make sure that maybe there's always something that you can improve on. And I think that's why we do a post-analysis every year. Looking back at some stocks from last year, you'd say, I should have been up 200, 300% last year, and I wasn't. So what do I need to do in order to handle winners better going forward?
Yeah, and I would just add, that with this, if you don't have the other books, I would highly suggest that, it's ridiculously cheap price for the effort and what goes into it. Anyone who knows me knows that I don't, try to push anything. I would buy all of them only if you're going to use them. And, I would take it where, maybe on every weekend you just take, 4 or 5 stocks and you say, I'm going to get through these, and really sit down with the MarketSmith tool at the same time and on your favorite ones. Use that change date, print them off. You're going to get so much more out of really using it. But if it's going to just sit on your shelf, don't bother.
Well said. And so, here's our contact information. Feel free to give us a call at 1-800-424-9033. Otherwise, shoot us an email at reaches@marketsmith.com. But yeah, on behalf of myself, Mike, the rest of the MarketSmith team here, we appreciate you guys attending, and have a great day.